Salute, folks. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor of Alonzo Hall, and I've returned to whap and tap on your head with another ADH wealth solution. Today, I'm going to show y'all what I've been talking about for the past decade and what the majority of my audience, which is black, doesn't seem to understand that rich white people tend to understand. So here's a email to me from Banking Truths, and they say 3 reasons why whole life insurance dividends destroy treasuries. You know, all those things that people get bonds and stocks sounding all goofy. Well, with any whole life policy, you're essentially buying the average from the insurance company. You see, Alonzo, mutual insurance companies have the benefit of collecting gobs of premium all the time from all their customers. So mutual insurance companies get to dollar cost average into not only rapidly fluctuating shorter term yielding bonds, but their longer term counterparts and everything in between. That's why I included the 30-year Treasury rate in orange, overlapped by the 2-year Treasury rate, slightly higher than the yield savings, but just as noisy. And don't forget, too, that when you own a whole life policy, you're actually part owner in the company. So you actually share in the profits from their other lines of insurance products, which further smooths out that long-term dividend rate. Let's take a look at this photo here. So again, the orange line is the 30-year yield on Treasury Bonds. So they were at 14% back in 1980 and up to 2022. This is a 40-year yield. They're spiking up to where cash value life insurance is spiking down to. And basically, cash value life insurance has stayed even while everything else has plateaued. It's trying to spike back up, but it's not going to spike up with Treasury yields on a 30-year or a 2-year rate versus cash value life insurance. Also, once a policy receives a higher dividend payout than it was expected to receive, it gets added to the guaranteed cash value. By contract, the guaranteed cash value is guaranteed to grow every year. But it also factors into how much ownership you have in the underlying mutual company. So having more guaranteed cash value entitles you to future dividends, which increases your guaranteed cash value, which gets you more dividends, which grows your guaranteed cash value. So take a look below at the originally illustrated dividends from this policy versus the actual dividends paid in the table below. Just 5 years into the policy, the actual dividends paid were more than double what was originally illustrated, and dividends stayed that way for the next 35 years. This was a hypothetical $250,000 whole life policy on a 50-year-old, and he's only paying $14,000 a year, or a little over $1,200 a month. Again, folks, if you want this life insurance and this generational wealth and these investments, you can't buy a Porsche with $150. You can buy a Yugo, but you're not going to get a Porsche. You want a Porsche, you got to spend the money for a Porsche. See where that highlight is straggling those 2 columns above? That highlight right there? Well, that's the biggest difference, where the actual dividend was 2.6 times higher than it was originally illustrated to be. So total dividends, the illustrated value was, he was supposed to have made $12,796 off of the dividend with the paid up cash value on his life insurance. The actual difference, because of compound interest and the dividend growing off of what happens to be there each time, so he gained actually $33,523 in dividend interest. So he's actually up 162%. Show me your stockbroker guy or your investment guy who's like, yeah, invest in this for 10% year over year, and can guarantee it. What's super interesting about this is the actual dividend rate in 2015 was lower than what it was originally illustrated to be. As you can see below, the originally illustrated 8.27% dividend rate was that or higher for only the first half of the total 42-year period. Yet if you look back above, the actual dividend payouts from 2005 to 2020 were all much higher. So you can see that here, participating whole life policies. So their interest dividend rate or in dividend interest rate in 2002 was 12%, right? They actually got 8.10%, right? They got 6.7%. So every year it's growing, and mind you, it's compounding on itself. So wait, what's going on with that? Well, once any higher dividend is paid and rolled back into the policy, then it's almost like when you see a snake eating a big animal on the nature show. It has to keep making its way through the snake. So if you think dividend rates will be higher in the future, then whole life insurance is a great way to lock in a lifetime's worth of benefit from them, even if they're short-lived. You can see the corresponding effect on the total cash value below. The disparity starts early and just keeps diverting to the good. Now, ladies and gentlemen, I know what I'm looking at, but this also pisses me off when you guys aren't licensed professionals, because you'll be asking me to send you this. And right now, I know if you're watching this, looking at these charts, you have no fucking clue what I'm looking at, except for what I'm telling you. So stop asking the professional, send me some information. You have the professional there. That's the information. Keep this in mind. When you're looking at one of today's whole life policies, we're still literally at the trough of historic dividend rates, as you can see with the yellow line below. Remember, too, that because whole life companies have massive balance sheets, it takes them a while to collect enough premium to catch up to noisy spikes in short-term interest rates. But the benefit is, as these short-lived spikes subside, it also takes longer for the dividend rate to fall, so your whole life policy enjoys these higher rates for longer. But the long-term benefits are definitely worth it when you stack the qualitative benefits onto the math. Plus, whole life has a natural advantage with the math since it's immune from future tax hikes. With over $33 trillion in debt, it's not a question of if, but when tax rates will rise dramatically. Hopefully, you enjoyed my summary of this in-depth look at how whole life locks in higher rates for longer. By the way, the whole full video where all the picks came from is available below if you want to get the full play-by-play. Also, if you're ready to see your own situation modeled, be sure to grab a slot on my calendar and I can build it out for you and answer all your questions. Until next time, banking truths. So the only thing here, ladies and gentlemen, is I don't like whole life insurance, personally. I like universal life insurance. It's everything whole life is, but on steroids. Anyway, folks, that's going to be it for today. Wipe ass, work in progress every day and see success. And remember, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.